Welcome, everyone. And we have 30 minutes to solve this so that you guys can relax for the rest of the day. We'll try and make this as sort of dynamic and as lively as possible, as honest as possible as well. To be transparent, we didn't do any prep, so these guys don't know what I'm going to ask them. And hopefully that will make for a good conversation. We'll do a quick round of intros. My name is Brian, I'm a partner at Novastar. We are a VC fund investing across the continent. We've been doing so for over almost 12 years now. Yeah, great to be here. And
my name is Bunmi Akinyemiju, and I'm the founder of Venture Guardian Group, which is essentially a venture builder of SaaS companies. And I'm also the founder of Greenhouse Capital, where we do VC, but in a different way. Thank you.
Ross Strike is SVP Investor Relations at Moniepoint. Moniepoint is building Africa's all-in-one digital financial platform for SMEs and their customers. We are one of the largest fintechs here in Nigeria, and we're expanding across the continent. Thank you.
My name is Daniel Adeoye, partner at Verod. Verod is one of the leading PE and VC investors investing in West Africa and across Africa as
well. My name is Funso Akere. I look after M&A, mergers and acquisitions for Africa regions at Standard Bank, which is our 19 markets outside of South Africa. Been at the bank for a little and a bit. Prior to that, ran the investment banking business in Nigeria for 8 years. And I'm speaking last because they say customers first, so I can see clients and potential clients, so let them have a go first.
Thanks, Misha. Let's just dive into it. Ross, I'll start with you. Could you maybe talk us through what does exit readiness look like at Moniepoint today, and how does it look like today versus you've been part of the Moniepoint story initially as an investor, but now as an operator over the last couple of years. How's that changed over the last 5 years? And what are sort of prospects for you moving forward?
No, the first thing to say, I think, is that obviously everything comes down to the business. So if you don't have a good business, there's no point in spending a lot of time on exit readiness. And obviously, if you have product market fit, if you can show people data on growth, good unit economics, path to profitability, I think that's the foundation for everything else. I don't want to say that the main problem here is your IR team or the way you're presenting to investors. Most of the problem is, at least from when I was an investor, is do you have product market fit? Can you show people data to support your potential to be a $1 billion plus company in the future? With that said, I think exit readiness, as soon as you take external capital, everyone, board, founders, advisors, should be asking themselves, who's our buyer? And it might not be your desire or your target, but you should know, in today's reality, these are my 3 buyers. Not who I hope buy the company. I hope OpenAI or whoever buys us for $10 billion, sure. I hope Square buys Moniepoint. But actually today, who do we know will put money to work in Africa? Which companies do I know can list NGX, LSE? What has actually happened? And let's have a base case around that. And that's, I think, the things you can do there, talking to the right people at these companies, as investors, as board members, building those relationships, and just making sure that you're actually building a business that can be sold, as opposed to building a business that you hope can be sold one day.
So what are Moniepoints? What is your prospect? I like your answer, but you didn't answer. We're about halfway through the journey, I would say. So we've provided some exits through secondary so far. I think where we're today is building things like risk finance function. So when investors ask a question, it's not, oh, we'll come back. It's we've thought of everything, at least first degree, second degree answers. We have data to support it. And then we're also being able now, I would say, to predict our performance pretty accurately a year out. So it's still storytelling, don't get me wrong, and we're still selling the dream, but we're also selling a business machine that has some predictability as well. Thanks, and I'll flip over to Fusha.
CP showed us some data that says 16 to 20 years is really more standard for really excellent fund performance, which is interesting because you'd argue venture in Africa is maybe a decade old, if at all, right? It's much younger. So from your experience, having done this and seen other markets as well go through this journey, how do you place our evolution, India, LATAM, other regions that you've seen walk this path?
Yeah, thanks. That's a really good question. I would say we've made good progress to date, but we're still a few steps behind, emerging regions like India and LATAM. What you've seen so far are strategic acquisitions. We've seen less of early stage funds exiting to the bigger, larger, funds. I think Moniepoint is a good example of where, and you spoke about, the recent transaction you've done and, the kind of exit you provided for early stage funds. But we're still behind. We don't have a deep enough IPO market, for example, where, VC firms or investors and, VC companies can plan towards an exit. But we're making good progress. So in South Africa, for example, earlier in the month, we just closed Optasia's IPO, and that raised $375 million. And, we saw 150 investors in South Africa, across Europe and the US. And interestingly, in the middle of the transaction, there was an M&A deal where an investor bought a chunk, which then provided a good anchor for us to price. It's still early days. I'll say we're probably about 8 to 10 years behind, but we're making the necessary strides. But there needs to be, quite a bit of work just to ensure that, as companies reach, as companies get to, when it's time to exit, you can go, for example, to the Nigeria Stock Exchange and be able to IPO or run a dual track where your IPO market is competing against strategic M&A. Yeah, so there's less dependence on, regional or international strategic players to provide you with the exit, and more dependence on maybe local institutional capital.
So should we just stop like huffing and puffing about exit and wait? Is it just a function of time, or is there anything we can do? We're 8 years away. We should just wait 8 years and then we'll get there. Or are there things we need to do today that others did in those other markets that could help us realize that 8-year sort of journey?
Yeah, no, you have to start planning now. And I always say that you have to think about who are you going to exit to? Are you going to exit to, is it a local or regional player, or are you going to exit to a international strategic? If you're going to exit to a local institutional investor, follow-on fund, etc., obviously there are trade-offs. You could get a quicker, cleaner deal, but you're going to leave some money on the table. If you wanted the big payout, then you've got to start to think about how do I exit to an international or strategic player that's looking for market access or tech capability. And to do that, you have to start right from the get-go, building your equity story, putting the governance in place, and just ensuring that, you're delivering every time you come to the market to raise money, you're delivering. And you're thinking about little programmatic M&A that allows you in a structured as opposed to maybe an episodic manner to, build your capability out so that when it's time, for example, if I look at a Stripe and Paystack, when, you have international strategics just looking for market access, you tick all the right boxes and, you can get a relatively decent deal.
Thanks. And Bunmi, I'm curious your view on what Funso just talked about. Invest in companies earlier in their journey. How often are you encountering founders who can even remotely begin to think about those things, and should they even at all at that stage?
Yeah, thank you very much, Brian, for that. I think from where I sit, this is very real for me, right? Because I have 65 companies that I've invested in. You know, we started quite early, right? And so it's a case where maybe the macro says we still have 8 years to go for the maturity of the market. But on one hand, it's an existential, issue for us, right? Because we've invested in these companies for 10 years. So we can't wait another 8 years. On the other hand, I think there's also an incredible opportunity, because from Kola's presentation earlier, the Paystack exit happened, and they went out to raise a fund, and like 75–80% of the LP allocation was local. It means that if there are 10 exits in a year, the dimension of the knowledge, the understanding, the confidence of the asset class improves. So for me, it's then a simple formula. Can we orchestrate this faster? And if we do, because we have the benefit of studying other markets, we can literally change the game overnight. And I think that's maybe what I'm interested in. I'm more of a builder. I'm not a finance person. So when I dabbled into VC, I realized that, VC is not for me, like per se. So I started thinking about what are the market failures and can we solve it? And I really think there are 3 things that we can solve it to bring that 8 years earlier. I think the first thing is, can we orchestrate these exits in a more sort of frequent, higher velocity way, which kind of comes down to, I think, a mindset shift and partnership. In this room, for example, are those trading activities happening amongst everybody? So can we orchestrate it? I think the second thing is sort of the interconnectedness between Angel, Series A, Series B, Series C. That capital stack, can you make it a lot more connected, right? Which I don't think is hard. It's just partnership and people talking to each other. Hey, what's in your portfolio? You are late stage, I'm early stage. I give you, as a VC, I give you my data room. You grab the ones you like and we trade. Because we know that as a whole, it helps everybody, right? I like what Dotun said earlier. It's like building an engine without an exhaust. So the liquidity is the exhaust. And I think the frequency of the story can essentially make this a thing that starts to happen immediately. It's just collaboration and a mindset shift.
Thanks, Bunmi. And Daniel, your reaction to that, because you guys have done it in a shallow, disconnected market. How have you managed to pull off this environment? And secondly, this elusive local capital, right? Every single, I think, panel or conversation like this that we have, we always hear about local capital, local capital. Is it that those guys are not in the room, or are they not hearing this? How do we tap into those markets? Or what is preventing them from?
Sure. Thanks, Brian. Look, Verod has been able to engineer at least 15 exits, right? And I use the word engineer intentionally, right? A lot of people look at exit like it's a prayer, faith. It will happen, it might not happen. But at Verod, from day 0, we're thinking about the exit, right? How am I going to return capital back to investors? And we've been able to do it in several ways. I mean, fortunately for us, we look at more mature companies, so it's easier to engineer. So for instance, there's a company, CSCS, right? That was in Fund 2. It had $100 million in its balance sheet, right? And it was going at 3 Naira per share. It was a no-brainer deal for us, right? Even if it meant I paid 6 Naira, right? I go into that asset, I quadruple the dividend distribution, and even before my exit, I'm already at a 1x in cash, realized capital. So there's the financial engineering side of it where you find a great asset, all right? We sit in a lot of cash and you distribute that cash. The second thing is also empowering the management team, right? there are a number of deals where we've backed management to buy out shareholders, right? And then that same management team also want to own the entirety of the business. And then we find funders to back them to buy us out as well. Those are always typically my favorite stories because you're creating wealth for generations, right? And then there's a third bit of time and chance where you know at certain inflection points, you need to make a lot of noise about a company. And if there's a particular trend going on, say decarbonization, everybody's talking about going green. And then we decided to back Daystar Power, right? And the goal for us was quite simple. Once I get to 200 locations, I make a lot of noise. Once I get to 400 locations, I make a lot of noise. At every inflection point, you make a lot of noise because the world is listening, right? By the time we got to 400, and we did the head office of EcoBank in Togo, right? You had likes of Total, Shell knocking on our door, right? So the time and chance piece was the decarbonization story was hot. All the oil and gas companies needed to start buying up green assets. And to your point around exit readiness, it's a PE company. Governance is great. There's full financial transparency, unlike other firms where it was a no-brainer choice for Shell, right? And Shell bought us out. There's also the case around your sponsors buying you out. So you have, in Nigeria, people are very passionate about their equity, right? And you tell them, like, look, we'll give you that option to buy us out at a certain valuation, right? Let's grow this thing together. If you think about the pension business we exited a couple of weeks ago, when we bought that asset, the AUM was 50 billion naira. When we exited, it was 500 billion naira. If you understand the economics of a pension business, once you cross 200 billion, you're making over 100 million in profit every month. So you can easily calculate your yield as a shareholder, right? And then they bought us out, right? I think there's also the case, we've also had an exit on the Joburg Exchange as well, but that was back in 2010. Again, it was a pension fund that bought us out. Are there any pension funds here? So you see, that's the problem, right? Pension funds in Africa are sitting on $500 billion worth of cash. 80% of that goes into government securities, right? But government securities are giving you less than real-time returns. So we need to bring them into our ecosystem. A third of my time now is spent in rooms with CIOs of pension funds, educating them about the asset class. So we need to do a lot more with that, right? Like now they're not in the room, right? How do we expect them to write checks, right? And then on the local capital side, the way the oligarchs and the really rich guys in our country think about things, it's all about the yield for them. They don't care if your GMV is 100 billion. The guy is going to ask a very simple question. If I put this cash in your business versus putting it in a bank, what is the opportunity cost of that capital? If you can't show them, right, that you're going to make the same return or even higher, they're not going to write a check. We sold to a few HNIs, and it was very simple. It was like, Daniel, this is it. There's some people in the room here that negotiated one of those deals for us. It was, look, I could easily buy T-bills. Why should I put money in your business? You can sell the impact story. You can sell the fact that you're changing Nigeria, creating jobs. It's a nice to have, but at the end of the day, for the guy, it's the yield, right? So, and that's the last thing I want to talk about. Again, we're fortunate. It's more mature businesses where half the time I'm thinking about the free cash flows of the business, right? And from those free cash flows, how much can I give back to investors? So for all founders here, I don't know how you want to do it. Like, how do you create liquidity for your shareholders before the exit, right? Because always the exit is not the ultimate. So as a new investor, if I see you're always distributing cash, right? It makes me easier because then I'm thinking, okay, if I put this money, I don't need another exit because I'm going to get money from free cash flows. So it's absolutely critical. I understand the challenge of, look, we're trying to grow this business, but return money back to your investors. Even if it's a couple per share, just always return capital back.
Thanks, Daniel, for that very candid response. We have about 10 minutes to go, so I'll do maybe a quick fire one. Ross, to you, I think reporting, all sort of the boring internal things that you need to do to be exit ready. How has that evolved at Moniepoint, and what are some of the things you've had to focus on to as you walk sort of this journey towards exit?
The key two things are financial controls and systems, and actually Nigeria is incredibly deep talent in that regard. So I wouldn't say it was easy, but once you have a profile and money to pay people competitive salaries, for us, the banks, I've been amazed at the depth of talent in the finance function specifically. And the other one is board and governance. And actually that's another one where, at least for us, we're regulated by CBN. We take it pretty seriously, always have for that reason. But I think it's having dialogue with your board members beyond just the board. And obviously, Brian, you've been there for a few years now, so you know how it is. But I think we've gotten better at, a few board members will join us for M&A discussions, and we'll leverage their expertise in that. There's some others that will be more on the balance sheet side. So I think we've just gotten better at leveraging people's advice and then make sure we're actually to track against that progress.
Thanks, Ross. Michelle, I'll jump over to you on a different tangent, but do we have enough buyers for companies?
That's a tough question to answer. I'm optimistic. I think the answer is yes, right? He says he's done 15 exits. I wonder why we probably should take a floor in your building. So every day I wake up and I resume at your office. Hopefully I can get half of that. But if you look at, I work for a financial institution. Every time I see a Moniepoint, or back in the days when I see a Moniepoint POS, I'm always saying, but why don't you use, a Stanbic POS? So whether it's at the petrol station or at a supermarket, etc. And the person selling will go through pains to demonstrate to me why Moniepoint is light years ahead of all the other banks. So I think that's key. There's I've had the benefit of 25 years in this market or African markets, and markets go through cycles. There were periods where you couldn't raise $20 million, and all of a sudden, from 2003 to 2008, you went to raising $1 billion. We raised $1 billion for MTN from 100 investors. But in that period of time, the market was doing, IPOs and, raising billions of dollars of capital. And then we went through another wave, 2010 to 2015, where everybody wanted to invest in Nigeria. And we were bringing strategics in, and, there was the Tiger Brands transaction, there was Famous Brands. There were people looking at the market. So we shouldn't beat ourselves up too much. For any company to still be standing after what Nigeria went through from, it started 2015 till 2023, this is enough to wipe out an entire market. But the businesses have delivered local currency growth and are catching up actually in dollar terms. So we've had a one in a lifetime event that could have, completely destroyed the industry. So back to your question, the answer is yes, but a couple of things need to happen, and, those success stories are being told. There are few exits, the Moniepoint transaction, the Optasia IPO, and I think, as companies continue to refine, streamline, they become more efficient. As the market opens up to Nigeria in particular, we will see the flows. But the businesses exist. You're solving problems that, many markets you're solving problems that will be relevant globally, but solving them with limited resources. So imagine if you if that technology or tech capability gets in the hands of a global player, it's just invaluable.
Thanks for sure. Bunmi, do you think assets in Africa are overpriced?
That's a good question. I think it depends on what asset we're talking about. Are we talking about early stage company, mature company, which I think is also
in a way that prevents anyone from buying them because they're too expensive.
Yeah. So that's my point. I think it depends. And I think everybody needs to go through this process and decide both as an entrepreneur, as an investor, are you building an SME? Are you selling an SME? Are you buying an SME or a venture company? I don't think we have that conversation a lot because it changes the perspective. And so that's why I've been evangelizing this idea of camels, right? Because within our venture studio, Venture Garden Group, right, we built 10, 15 companies between 2010 and 2015. We raised almost $20 million in 2014. We exited the investor in 2020. And I learned so much through that process that if you're building an SME, you price the SME, you price it like an SME and you sell it to somebody that buys an SME, or you sell it, or you don't need to sell it because you're generating dividend. And that's okay. I think the challenge is most people are not clear about what they're building, and everybody wants to be Moniepoint and be a unicorn, and I think that's what's broken. Because 80%, 90% of people should probably just build a camel company, $5 million ARR, 50% profitability. There's an 80% chance that business will be successful, and it will generate generational dividend for the founders. Again, I've done it. I've built this 6, 7, 8 times. It's not that hard. But the moment you're not sure, one day you're building an SME, the other day you're building Moniepoint, then you raise too much money, then it will be overpriced, which leads me to my second point, that there are lots of buyers. I think there are a lot of buyers in the market, and I think the buyers need to be the corporates, the banks, the telcos, the conglomerates. They're slow, they don't have innovation, they don't have the staff, they can't hire all these young people and retain them. So why don't you just buy companies as a mechanism to drive innovation, and inadvertently, we will be creating that exhaust pipe that allows retail participation in VC and PE. Everybody will be rushing to really participate the way we saw, the India story. So I think the solution is here. We just need to align, collaborate, educate the market, drive deals, and then I think we'll just take off.
Thanks. 2 minutes. Ross, curious about your response to that. Do you think $1 billion is a fair price for Moniepoint?
Definitely not. It should be much higher. No, but I'll just say that I think the market, the potential, I'm very positive today versus where I was 1 or 2 years ago. So I think some of the macros going in the right direction. We do have, if you're building, again, a business machine of real value, if you can show I have these customers, they're using my platform every day, global companies do get that. And I think once the mood changes a little bit on Nigeria, that's when you'll start to see some big acquisitions, because it's, especially for the tech companies, it's the last market. There's no one else there. So they do see it as an exciting opportunity. But you need to be able to show them, I have something you can build. And then that's when you can command the valuation exits we all want.
Daniel, resounding yes to that question. So you think they're overpriced? Just maybe 30 seconds response.
No. I think the only concern I have is usually ticket sizes in this market for exits are in the range of $50 to $100 million. So there's such a thing as being a strategic fit. So sometimes this market will penalize you for becoming too big. So it's something you always have to watch. Because even if you're going to a strategic, if they're going to write a much larger check, then you need a board approval or shareholder vote, for instance, to write $1 billion. But we're invested in Moniepoint, so yes, I think it's undervalued for sure. But there's such a thing as the strategic fit. Don't wait for too long. Don't become too big. Once you hit a certain scale, given the check sizes people write for this continent, exit.
Michelle, if there's one takeaway from today, or something that we can do that's actionable to move us in the right direction, what would you say?
So a couple of things. One is to start to think about exit seriously right from the get-go. And, lots of free advice you can get. Speak to your bankers, speak to investors, etc. Because the market can change very quickly. And, it just takes one deal that then opens the floodgate. So start to think about exits. Think about, the potential for a listing. Think about, who potentially, I would say you should have at the back of your pocket a black book of potential buyers, and you refine that, sort of as time goes along. So who are the strategics that potentially could buy you? Who are the, as now we're seeing private equity play a bigger role, who are the firms that could potentially buy? The second thing is programmatic M&A. And sorry, lastly, Bunmi, you raised the point about generational wealth. I say you, and it's interesting, I've known Bunmi for 20 years, so he's had this long-term view, which is always good to see. But I think the difference between, I find with South African businesses and the rest of the continent is that they build the businesses to sell them. Then dispassionate about, the long-term dividend. They're building the businesses. They get to a point in time where it's better for somebody to run the businesses. They exit and do something else. So again, that's to close that point. Then on the second point around programmatic M&A, which I find we're still behind most of the market, is to start to think as you build your businesses and raise capital, what do I need to buy that makes me more compelling, or that allows me, move into a related area or get some adjacent technology or tech capability? And I find that, we still have many companies doing the same thing, when actually, they should be merging, or investors in the companies getting together and seeing how they can create synergies, and that just allows businesses to scale up fast and get to exit. But look, we're on the right trajectory. We've gone through an extremely tough phase, and I think the next 3 years are going to be extremely important. So what gets done in the next 3 years will shape the VC industry. Thanks.
Thanks, and with that great provocation at the end there, I think we'll call time on this panel. Thank you so much for the conversation and for your time, and thanks everyone for listening. Sorry we couldn't get to questions, but
thanks.